$6.5 billion. That is the number federal prosecutors say moved through a fraud so simple it almost defies belief. Not a complex derivative scheme, not a web of offshore shell companies, invoices, pieces of paper, or the digital equivalent. That said money was owed for goods and services that never existed. Two brothers, one company, and a network of lenders who believed every page. The question is not just how they did it, the question is how it ran this long, at this scale, without anyone stopping it. What you are about to hear is drawn directly from the federal indictment unsealed in the Southern District of New York on January 29, 2022. The invoices were not. First Brands Group positioned itself as a straightforward business. It operated in the consumer product space, the kind of company that sells recognizable household goods through established retail channels. On the surface, the structure was unremarkable, a company with revenues, with customers, with purchase orders flowing in and out. That surface was the product. It was designed to be believed. According to the federal indictment, the scheme at the center of First Brands was a form of invoice fraud, known broadly as accounts receivable financing. The mechanism works like this. A company has outstanding invoices, money owed to it by customers. It sells those invoices to a lender or a factoring firm at a slight discount in exchange for immediate cash. The lender collects the full amount when the customer pays. It is a legitimate and widely used financing tool. Thousands of companies use it every day. The alleged fraud was in what those invoices actually represented. Prosecutors allege that the brothers at the center of this case, named in the indictment filed in the Southern District of New York, submitted invoices to lenders that did not correspond to real transactions. Goods had not been shipped. Services had not been rendered. The customers listed on those invoices either had no knowledge of the obligations attributed to them, or, in some instances, the customer relationships themselves were fabricated or materially misrepresented. The lenders advanced real money against those invoices, hundreds of millions at a time, then more again. Because the invoices kept coming, and because the paper trail was constructed to look like a functioning, growing business, the credit lines expanded. Lenders competed for the relationship. The company appeared to be scaling. This is the foundational logic of invoice fraud at scale. You do not need to hack a system. You do not need insider access to a bank's trading. You need a credible-looking company, a believable product category, and the patience to generate documentation that passes initial scrutiny. First Brands, according to the government, had all three. The indictment describes a pattern that developed over years, not a single transaction, not a one-time desperation move, but a sustained, deliberate construction of false financial reality. Lenders were kept comfortable. Audits were managed. When questions arose, there were answers ready. The architecture of the fraud was, in the government's telling, the primary work of the enterprise, and for a long time it worked. The money flowed. The company grew its apparel. The brothers accumulated the proceeds of what prosecutors allege was a multi-year criminal conspiracy. From the outside, First Brands looked like exactly what it claimed to be, a consumer goods company doing business at scale. But there was a ceiling. There always is. Accounts receivable fraud has a structural weakness that no amount of paperwork can permanently conceal. Eventually, the invoices come due. The lender expects the customer to pay. When the customer does not pay because the customer never received the goods or because the invoice was never legitimate, the lender starts asking questions. At small scale, these gaps can be papered over. At the scale alleged in this case, they become impossible to hide indefinitely. Here is what no one saw coming, or at least what no one acted on in time. The volume of fraudulent invoices alleged by the government was not the work of a single bad quarter or a temporary cash flow crisis. According to the indictment, this was a sustained operation. The total exposure across lenders, as alleged by federal prosecutors, reached into the billions. Multiple financing counterparties were involved. Each believed they had a secured position against real receivables. Each was wrong. The mechanics of how the scheme allegedly sustained itself are worth examining carefully because they reveal something important about how institutional lenders can be manipulated over time. When a lender advances funds against an invoice and that invoice does not get paid on schedule, there are typically contractual remedies. The borrower can repurchase the invoice, substitute a new receivable, or provide additional collateral. In a fraud of this type, the substitute receivable is simply another fabricated invoice. The lender is paid back with money that came from a different lender advancing against a different set of false documents. The carousel turns. This is not a new mechanism. It shares structural DNA with some of the largest trade finance frauds in recent history. What distinguished the Firth Grants case, according to the government's filing, was the duration and the dollar magnitude. The indictment alleges losses and exposure in the range of $6.5 billion across the. That number deserves a moment. $6.5 billion is not the output of a small operation run out of a back office. It implies a sustained, high-volume document generation process, relationships with multiple sophisticated financial counterparties, and a management structure capable of coordinating the fraud across years without internal collapse. The government's case, as laid out in the indictment, attributes this coordination directly to the two brothers named as defendants. The re-engagement question here is the one every lender in this case must have eventually confronted. At what point does a pattern of slow paying or non-paying invoices stop looking like a business problem and start looking like something else entirely? The answer, based on the public record, is later than it should have. Due diligence processes that are designed to catch exactly this kind of fraud did not catch it quickly enough. Internal audit functions at the lending institutions did not escalate concerns at the pace the underlying data warranted. By the time the pattern became undeniable, the exposure was already catastrophic. Lenders who believed they held secure positions against a diversified pool of commercial receivables discovered that the pool was, in substantial part, an illusion. The documentation was sophisticated enough to pass initial review. It was the passage of time. The simple mechanical fact that invoices eventually need to be collected, that began to unravel it. And once one lender started pulling the thread, the entire structure was at risk. Federal investigations into financial fraud do not announce themselves. They accumulate. Subpoenas go out quietly. Bank records are obtained. Witnesses are interviewed under conditions of confidentiality. By the time an indictment is unsealed, the government has typically spent months or years building the evidentiary record that will support prosecution. The defendants often know or suspect that scrutiny is intensifying. The lenders, in many cases, do not know the full picture until the indictment becomes public. On January 29, 2026, the Southern District of New York unsealed a federal indictment charging the brothers connected to First Brands Group with wire fraud conspiracy and related offenses. The indictment laid out the government's theory of the case in detail, a multi-year scheme to defraud lenders through the submission of false and fictitious invoices, generating billions of dollars in fraudulent financing proceeds. The immediate consequence for the company was total. When a business's core financing structure is alleged to be fraudulent, the credit lines do not simply pause, they collapse. Lenders move to protect their positions. Counterpart, the operational infrastructure of the business, whatever legitimate activity existed within it, becomes impossible to sustain without access to capital. First Brands, as a functioning enterprise, effectively ceased to exist as a going concern at the moment the indictment became public. But here is the dimension of this collapse that the raw numbers do not fully capture. The lenders on the other side of these transactions were not abstract institutions. They were organizations with their own investors, their own depositors, their own counterparties. When $6.5 billion in allegedly fraudulent receivables are unwound simultaneously, they radiate outward. Credit facilities that were marked as performing assets on balance sheets are suddenly impaired. Provisions must be taken. Capital ratios are affected. The downstream consequences of a fraud at this scale extend far beyond the two individuals named in the indictment. The government's case, as presented in the indictment, focuses on the conduct of the brothers as the architects and primary beneficiaries of the scheme. Wire fraud conspiracy carries substantial federal sentencing exposure. The Southern District of New York has prosecuted some of the largest financial fraud cases in American history, and the scale of the alleged conduct here places this case among the most significant invoice fraud prosecutions ever brought. What the collapse also revealed was the gap between the apparent sophistication of the fraud and the relative simplicity of its core mechanism. At its heart, this was a scheme that relied on one thing above all others: the willingness of lenders to accept documentation at face value without independently verifying that the underlying transactions were real. The invoices were the product. The lenders were the market. And for years, according to the government, the market did not ask the one question that would have ended everything: did these sales actually happen? The answer, prosecutors allege, was no. Systematically, deliberately, and at extraordinary scale. No. As of the unsealing of the indictment on January 29, 2026, the brothers named as defendants face federal charges in the Southern District of New York. The legal process is at its early stages. No convictions have been entered at the time of this production. The defendants are presumed innocent unless and until proven guilty in a court of law. What is established by the public record of the indictment itself is the scope of what the government alleges occurred and the scale of the losses attributed to the scheme. For the lenders, the aftermath is a forensic exercise. Every invoice in the portfolio must now be examined against independent evidence of the underlying transaction. Did the goods ship? Did the customer receive them? Is the customer real? Does the purchase order exist in the customer's own records? This process, for a portfolio allegedly containing billions in fabricated receivables, takes months. It requires cooperation from dozens of counterparties. It produces, in the end, a number, the actual loss figure. That may differ from the government's initial allegations as the accounting becomes more precise. Recovery is unlikely to be substantial. In fraud cases of this type, the proceeds are typically dissipated over the course of the scheme. By the time investigators arrive, the money is gone. Civil litigation against the defendants may produce judgments. Those judgments may be difficult or impossible to collect. The lenders, in most cases, will absorb the losses. There is also a regulatory dimension to the aftermath. When a fraud of this scale operates within the accounts receivable financing industry, it draws scrutiny to the entire sector. Regulators and industry bodies examine whether existing due diligence standards are adequate. The question of whether lenders independently verified invoice legitimacy, and if not, why not, will be central to any regulatory review that follows. Changes to verification requirements, if they come, will affect the cost and structure of legitimate invoice financing for every company that uses it. The innocent participants in the market pay a price for the fraud too. The victims here are not abstractions. They are the institutions and, ultimately, the individuals behind them. Investors, employees, pension funds, and depositors whose capital was placed into financing facilities that were represented as secured by real commercial assets. When those assets turn out not to exist, the loss is real, even if the invoice was not. The lesson this case leaves in the record is precise. Independent verification of the underlying transaction is not a bureaucratic formality. It is the entire defense against this category of fraud. Every major invoice financing fraud in history has exploited the same gap, the assumption that a well-constructed document represents a real event. It does not unless someone checks. The check is not optional. It is the work.